Hello, everyone, and welcome to our fourth quarter webinar. I am Robert Clark, as always, joined by Chris Ingram. Let's see, we are here to highlight a couple big things, and since it's our fourth quarter webinar, we're going to talk about the fourth quarter of 2025, but we're also going to look at 2025 as a whole. And so, Tyler, if you can help me advance a couple slides here. There we go. Beautiful. So, the agenda for today, what I want to plant the seed most with is the reminder that we are not here to predict the markets. We're not here to tell you what will happen this year. The purpose of this webinar and this agenda specifically is really just to provide you with context as to why our portfolios are set up the way they are and why that's necessary for long-term growth, long-term performance. And so that's why we thought it was most helpful to, one, recap what the market did last year, because it's very prevalent for and rhymes, I guess I should say, with what we're looking at for 2026, and the importance of investment selection or stock selection along the way. And then we'll let you get out of here with a couple closing remarks on a key holding that we've had for 2025, as well as sharing our annual letter for the year. So without further ado, Chris, you want to take it away on the market recap?
Sure. Yeah. So 2025 was an eventful year. It feels like that red drop in the middle there, or in the beginning half there, was years ago. I mean, my wife said to me the other day, we were planning our spring break this year, and it dawned on me that was occurring during spring break last year. But it feels like it was much longer since then. But 2025 turned out to be another good year, which is part of what is awesome, but also some cause for concern and some things to think about is that we've been on a 3-year tear here. And had another great year in 2025. But it didn't feel like that in the beginning, right? You had a huge correction at the beginning of the year, huge, big, that was driven by the reciprocal tariffs and some of the Trump actions when he immediately took office. But all that was short-lived. It rebounded quickly, and the market never looked back. S&P 500 was just shy of 18% at 17.9. NASDAQ was up 21.1. Dow Jones put up 14.9, which that took a while to catch fire. Russell 2000, kind of the same thing, 12.8. International stocks, for the first time in a very long time, outperformed everything and had a phenomenal year in 2025. They were up 29.2. And the aggregate bond index had a very good year for the Bloomberg Ag at 7.3%.
So if we look at, the notable events, Chris mentioned the Liberation Day tariffs. Obviously, the market was spooked from the end of February to April at the very low, as those were beginning to come to fruition, became more of a reality, and then the severity ultimately in that was announced on Liberation Day, that being a key event for the market. But you had a couple other things at play. One, we finally started to see the Fed lower interest rates, which was a great sign for home buyers and for lending and for spurring economic activity. A couple trade-offs in that, especially when you look at safer investments. That previous slide was showing the Bloomberg aggregate bond index at about 7.3% last year, which was incredible for a safer investment. But when we see these lowered interest rates at the Fed level, those safer investment yields are also going to come down with it. And so that's something that we're paying attention to this year. We also have the AI-driven boom. And we talked about this a lot on previous webinars that we've shared here. But the concentration in the artificial intelligence and how that's really driving the market, what they're calling the S&P 493, which are the 493 companies that are not, the big magnificent seven, who are very much involved in the AI race. And so being mindful of that concentration in AI. And then obviously, we can't not talk about cryptocurrency. Bitcoin hitting all-time highs last year and now sitting where we are today, about 20% down from those all-time highs. So lots of drivers, lots of ebbs and flows in the 2025 market. We won't bore you with all the details on that screen, but it's there if in case you want to dive into more. Tyler, if you want to take us to the next slide. And this is where we'll get into what we're really looking at for the year ahead. And Tyler, next slide, please. One of the main points that 2026 will bring is the midterm elections. There's a couple other events that we're looking out for this year, but the midterm elections seem to be the strongest market player, I guess we should say, from looking at this slide. Historically, we looked at, okay, what does the market historically do on midterm election years? And you can see that a majority of years have a double-digit pullback at some point during the year. And now that last part is key because it's not necessarily saying we've had down years every midterm election year. It's just pointing out that there's been volatility. And if we look at, on average, what the market does 12 months after that volatility of a midterm election year, we're usually up by a double-digit percentage. I think the numbers that we're seeing here on an average basis is, one, you see the market pull back most frequently around that August to September timeframe. Those pullbacks range or average about 17%. That would be similar to what we saw from Liberation Day last year. But then 12 months after that valley, we see upwards of 30% in some markets. And so again, not a prediction. We have no idea what will happen. We might not have any pullback at all, or we might have a pullback and not recover. We are not here to guess what the market will do. We are here to explain why our portfolios are positioned the way they are, why we're taking a little bit of a defensive stance in the names that we're holding. And I think our next slides will go into that. Here again, we're summarizing, we're not predicting the future, but the likelihood of a 15 to 20% drawdown is typical from a midterm election year perspective. And that doesn't necessarily mean it's going to be a down year. A lot of the time we see the market recover and a lot of those losses or a lot of that volatility to end the year relatively flat. And then you can see again, historically, that recovery in the 20 to 40% range from a historical perspective. You want to touch on this one?
I mean, this is just expectations for where interest rates are going to go. There's in the middle chart there, it talks a little bit about where the anticipation is that inflation continues to cool. With that gives and opens up the door for the Fed to lower interest rates. That seems to be the goal. The target rate you'll see on there, it's in purple down there, for the FOMC is to get us to 3%. That's where they want us. And if you look at the little blue, dark blue line and the little squares or diamonds that are on there, it shows expectations by year end for the FOMC is to get somewhere around 3.1. So obviously they think their policies are sound. They think they're going to get as close to that 3% number that they're looking for. That is the goal, right? Is to go lower from where we are today. If you look at the market expectations are a little bit different. They're looking at, I think it's 3.49 or 3.46. I can't quite see it from here. So they're expecting maybe not to have as successful a push down and that we end a little bit higher than where the FOMC is anticipating we're going to end up. But there is that gray box is showing a pretty wide range of where expectations have been over the last couple of years, going back to 2024. And so, there is still a bit of a range, but I would say, if you really summarize it all together, the general idea this year is still that we should see pressure to the downside on interest rates in general, which if you're looking at your bond portfolio or capital preservation models, that's typically a good thing for capital appreciation in those portfolios. So you're going to get your yield, which I think our yield on the bond portfolio right now is somewhere in the 5.7-ish range. And then if interest rates drop and that has that positive impact on those portfolios, we might get a percentage point or two in capital appreciation on those portfolios. And so you could easily see the bond portfolios doing another, kind of like the bond Bloomberg aggregate that we talked about a couple slides ago, up 7.3. We could see bond portfolios do 6.5%, 7% this year, which is, again, having been in this business a long time, there were a lot of years where bond portfolios did 1%, 2%, 3%. So 6%, 7%, those are great numbers from a conservative asset class like our bond portfolio. So,
yep, completely agree. Here we go.
So I'll touch on this one, and I'm going to backtrack a little bit on some of the things that Robert was just talking about. And the reason I'm going to backtrack a little bit is the outlook for 2026, right? And what I want people to maybe think about going into this year, because again, Robert is 100% correct. We have no idea what the market is going to do this year. And if somebody tells you they know exactly what the market's going to do this year, they're lying to you and they're wrong. Because we don't know. It's unpredictable in the short term like that. What we do is we want to analyze the influencing factors. And one of the biggest influencing factors, while Robert mentioned those midterm elections, I would say one of the biggest influencing factors in this market right now is uncertainty. And the market hates uncertainty. It likes to have a clear path. And the murkier the path gets, the more unpredictable the market gets, and the more people have a hard time figuring out should they be buying or selling the market, right? And so you get volatility in those time periods. If you look at 2026, the midterm elections by themselves create a lot of uncertainty. How is that going to play out? What is that going to do to the political landscape? What are policies going to look like moving forward? That uncertainty of how those elections are going to turn out is one layer of uncertainty. Then you have some of the geopolitical risks. You have fear of war. You have our president who is very quick to move a lot of different directions, and he himself is very unpredictable at times. And so all of that uncertainty is going to layer on top of this market and create a little bit of concern about what is the path going to look like this year. And that uncertainty is going to create volatility and potentially creates the landscape for some kind of a pullback in the market. And the things that tend to pull back in this type of uncertain market environment tend to be things that are expensive, right? The first thing you sell is the things that are overvalued and look rich. And so that's when you start to see things like some of these AI stocks and some of the higher valuation companies start to struggle a little bit as people take their profits. They take a little bit off the table because they're worried about those things falling. And you get a pullback like what we saw with the tariffs at the beginning of 2025, right? And so that's where I think these midterm elections and some of these things have the possibility of creating that this year. And so just like if you went back and looked at one of our webinars at the beginning of 2025, we talked about the same thing. We said Trump and tariffs create a lot of uncertainty. We don't know how that's going to play out. And so we're going to take a little bit of a defensive stance. And then if you listen to our next quarterly webinar, you'll probably remember that we said, hey, that pullback in the market was a great buying opportunity, and we jumped in. We went the opposite and got more aggressive. And we're kind of looking at this year the same way. We've had a good run. Valuations have been a little bit stretched. So it's now time to play defense a little bit, look at value companies and a better valuation overall for our portfolios. And see if that volatility kicks in and if there is a chance of a pullback. But to Robert's point on that last slide, if the pullback happens, realize that historically the market tends to rally over 30% over the next 12 months, right? So if we get a pullback during that time period, we're not going to run away from it. We're going to run towards it and go, cool, we were defensive a little bit going into it. And now we're going to take advantage of that pullback and try and capitalize on the fact that historically there's a rally that's going to come on the back end of that, right? So really 2026, if you're looking at it through my eyes, that's kind of how I'm looking at it and trying to play it for you guys in different ways with the way the portfolios are positioned, right? Mm-hmm. And so this slide talks about something that I think is extremely important in that market environment, which is stock selectivity, right? So a lot of times you're going to hear buy the index. Just if you don't know what you're doing, just go buy the S&P 500 index, right? You hear that all the time from investment gurus on TV. But the problem with that is that the market has really not followed that for a while now. If you look at this chart here, that green line is the Magnificent Seven, and the blue line is the other 493 stocks that make up the S&P 500. And then the gray line is the actual S&P 500. And as you can see in the grand scheme of things, the Magnificent Seven, those 7 stocks have drastically outperformed what the other 493 companies have done. And the S&P 500 has clearly underperformed to a large degree what those Magnificent Seven companies have done. But I will also point out in 2022, you'll see in 2022, the stock market was down, and I think it says 19%. The 493 stocks were down 12%, and the Magnificent Seven were down 40%, 49%. I can't see it from here. Hopefully you guys can see it. But a lot, right? The Magnificent Seven dropped a lot that year comparatively to the broad market, right? So stock selection is not only important in the good years because it allows you to outperform those indices and be more specific in what you're holding in the up years to try and outperform the market, but they become even more crucial in the down years of knowing when to rotate, when to take some profits, when to adjust and get a little bit more conservative, have better value within your overall portfolio so that when you do feel those pullbacks, you're not suffering the fate of the Magnificent Seven in that bad year that you're dropping 40 to 50%, and you're feeling more like the broader market, which is, if you go back and look at our stock portfolio in 2022, we were more like the 493, only down about 12-ish to 13%, I think. And then if you look at 2023, we rotated back into tech stocks at the tail end of 2022. And in 2023, I think we were more like the Magnificent Seven and less like the 493. So again, where are we going this year? It's that mindset of trying to pivot and adjust in between those different sectors of the market and being very specific with the stocks that we select and why we select them to manage risk but capitalize on the upside at the same time versus just holding everything and riding the roller coaster. And I know that was a lot, but I hope it all made sense.
Makes perfect sense.
This just touched on because it touches on that. It's basically saying that when you have, it really boils all of what I said down into a slide here. It says that when you have a market environment where valuations get high and stretched, that it actually is not in your best interest to just buy the broad market. That the broad market tends to drastically underperform in the 1 to 5 year returns when you just buy the index in a high valuation market environment like we are right now. That it's even more important during these time periods for stock selection. And the reason that is because you want to find value. You don't want to go to the store and buy everything that's overpriced. You want to go to the store and look for the discounts, right? The stock market's similar. We're out there looking for things that have appropriate valuations. There's meat on the bones, right? For them to be able to either hold value in a difficult time or even potentially rise, even if the broader market is not doing well, right? So stock selection becomes incredibly important during these time periods, especially when you think about what we said before, that the indices like the S&P 500 are so heavily weighted to the Mag 7 that there really isn't a lot of diversification there. It feels like there's 500 stocks, but that indice is being moved by 7 companies. So when valuations get stretched, it becomes even more crucial and more important to understand your stock selection and create true diversification within your portfolio to manage more volatile times. And again, lots of information. Hope it all made sense. Wow, we got there fast.
Love it. Yeah, you're welcome. Quick update for clients in our stock portfolio. You're very well aware at this point that Warner Brothers has been one of your most prominent holdings. Warner Brothers, in case you're not aware, if you've been under a rock or just don't watch the news, which I applaud you for, Warner Brothers is looking to be acquired. We have Netflix and Paramount in a bidding war to acquire Warner Brothers and its assets. And so this is generating not only a lot of headlines, but also as a stockholder and a shareholder of the company, you will receive and have been receiving emails with regarding the tender offer. And so this is basically your opportunity to vote your opinion of accepting these acquisition offers, declining it, rejecting, etc. More or less, we just wanted to take this opportunity to, one, tell you a little bit about Warner Brothers in case you're not looking at it in your portfolio. We added Warner Brothers when no one wanted to touch it. It was getting bad press, low valuation, low stock price. So everyone was trying to sell it, get out of it. They thought it was washed up, wasn't going anywhere. But our investment analyst team really took a liking to Warner Brothers, not just from a valuation perspective, from what we were just talking about, right? The assets, the potential assets, and the forward-looking assets were very fair or very strong compared to the stock price. But also, when you look at their intellectual property, there's not too many. There's no other company that can replicate what Warner Brothers has from intellectual property.
Maybe Disney.
Exactly, yeah. But those assets.
Yeah.
And so we liked it from that perspective. So we added Warner Brothers at about $8.50 a share to the stock portfolio. And today, I think one of the more recent in the $28.50 range. And so that's a healthy outsized return in a relatively short period of time. But all this to say, you're receiving emails about a tender offer. There's nothing that you need to do. We're taking care of that at the firm level. Warner Brothers rejected the most recent tender offer, and we agree with that rejection. And so if you have questions, if you continue to receive those emails, absolutely reach out to your advisor. We're happy to talk you through it. But the main message being there's nothing that you need to worry about on your end.
Yeah, and I would just say that from those of you that were in it the whole time, I got a lot of questions of why Warner Brothers, right? I think you got it too. Why Warner Brothers? Why did you guys add that to the portfolio, right? And I think not that all of them are going to turn out like this, right? But you do have to understand the philosophy of what we're talking about, right? Like there are times where you're trying to find a company that is a great company, has value, has something to offer, but that has been overlooked by the average investor, or it's been beaten down by other areas that people aren't seeing. And with Warner Brothers, it was largely the television side. TNT was losing a contract with the NBA, and there was a lot on. But at the same time, the HBO Max app was the most downloaded app internationally. And there's this amazing content on, the HBO Max network, right? And so where the investment team really saw the opportunity is that when the stock price drops and gets really cheap, it also becomes a great takeover target for another company to say, hey, we can buy this company at a much
pennies on the dollar.
Yeah, and bring in all this content and merge it into our world, right? And that's what you're seeing with Paramount and Netflix right now. Is Netflix clearly a very good content creator on its own, but think about what Netflix could potentially do with Game of Thrones or with the Harry Potter series or on and on and on, right? There's a lot there. The DC comics. Kind of like when Disney went out and bought Star Wars. You've seen how much content they've created out of that name brand, right? There's just a lot of opportunity there for them. So this was a home run, and it did really, really well this year. But again, that tender offer, we're getting a lot of questions about it. You can just ignore that. Don't even worry about it. We are on top of it. One other thing before we get to this quarterly letter here. that I'd like to talk about just in general. So just to summarize that outlook for 2026 and take it out of my mouth or Robert's mouth and give you just kind of what analysts' expectations look like this year, is that at the beginning of the year, you're going to get a lot of analysts that are going to come out and give you an idea of where they think the S&P or the markets in general are going to end at the end of the year. And they tend to range between a 7% to a 12% number. So I think that high single digits, it's a more tempered, expectation this year. People are being a little bit more cautious, but the general thought process amongst analysts is still for a positive year, just maybe not quite as crazy as what we've seen in previous years. What I've been adding in my conversations with my clients is that think about what we just said about the bond portfolio, 6 to 7%, and you're talking about a stock market that they're saying could be in the 7 to 12% range. Let's just say 7 to 10, right? 6 to 7, 7 to 10. Don't be afraid of bonds this year, right? I mean, from a risk-reward relationship, when you're looking at a market environment that has stocks with volatility that might do 8%, but you can be in a stock portfolio with a little bit less volatility and less risk and maybe do 6.5% this year. It's a great year to just make sure that there's, if you have bonds, by all means, keep them in the portfolio. And if you have some extra cash lying around that you're not investing right now, that bond portfolio is a great place to park some extra money. And it's probably going to have a very good outcome by the end of the year. And so I've been telling lots of people, I think cash at the bank is a mistake unless you need it in the short term for some life event or something that's going on. But if you don't see yourself needing it for the next 12 months and it's sitting at the bank not doing anything, this is a great year to invest that money into something like a bond portfolio or more conservative assets.
Love that. That's a great point. Well, wrapping up here, we had talked about, market recap, what we're looking at going ahead, the importance of investment selectivity, and then we have a couple more details in our 2025 annual letter that our investment management team put together. Hats off to Eric Abrahamian once again for not just, really helping to construct that letter, but putting together these slides and all of our research, phenomenal work. If you would like a copy of this annual letter, just send us an email, info@prosperitasfin.com. Just put quarterly letters either in the subject or in the body, or reach out to your advisor, send them an email, and just let them know that you'd like a copy of the annual letter. We're happy to give that to you. It goes a little bit deeper dive into some of the winners and losers of our portfolios over the year, and other things that we're looking for going forward. So,
yeah, and the only thing I'd say to end it is 2025 was a great year for the markets, great year for your guys' money, your portfolios. It was a great year for Prosperitas as a company, and we just want to say thank you to all of the clients out there that are watching this. Everything we do is for you guys, and we really appreciate the support and the feedback and you guys putting your faith and trust in us to help you with your finances and your investments. So thank you for that. And we're looking forward to a great 2026. And we appreciate you guys. So thanks for tuning in and thanks for being part of the family.